Good evening. I'd like to welcome you all to the final lecture of this year's Institute on World Affairs. Before we begin, we would like to invite anybody interested in planning next year's Institute to a planning meeting Monday, November 9th at 4 p.m. in the Pine Room. Hazel Henderson is an independent futurist and interdisciplinary policy researcher. She has spent 6 years on the Advisory Council to the U.S. Congress Office of Technology Assessment and is a consultant on alternative development policy in over 30 countries. She has written over 200 journal articles, and her books include Creating Alternative Futures, The Politics of the Solar Age, and Paradigms in Progress. This is a copy of her new book. Ladies and gentlemen, Hazel Henderson.
Good evening. Now, I'm just wondering whether we could have the lights down because I want to use this projector. Can somebody put these lights down a little? So, redefining wealth and progress. I have approached economics really as an outsider, and I've tried to look at the different ways that economists look at the world from the way futurists or systems theorists look at the world. Now, I'm going to need some, I think I may need some help with this. Okay. And basically, economists base most of their models on past data, whereas futurists tend to construct scenarios looking at trends and how they're going to interact in the future. Economists assume equilibrium, and in the increasing sort of hurricane of global change going on in the world, this seems to be a little unrealistic. Futurists and systems theorists basically see human societies and ecosystems in a state of constant disequilibrium. So it's a very different view of the world. Economists, as you know, always assume that at some point things are going to get back to normal. And I think this is where futurists take a very different approach. We do not ever expect anything to get back to normal. We think that societies are evolving all the time. And I won't go all the way through this list because I'm sure that you've been discussing some of these differences this week. I think probably one of the most interesting assumptions that economists make, which many people from other disciplines don't share, is the idea that human beings are only behaving rationally when they are being individualistic and competitive with each other. And as you know, in the economic textbooks, cooperative, caring, sharing kind of behavior is actually considered irrational. So this just might give you some examples of the way I look at the world rather differently. So I've focused a lot of my attention on the whole assumption that economists make that the goal of societies is that of economic growth. And in a sense, we are really trapped. Almost every country in the world is trapped now in this assumption that economies have to grow. And what they mean, of course, by growing is growing according to the traditional measures of gross national product or gross domestic product, whichever makes their numbers come out looking more favorable. And basically, as many of you know, the GNP was put into use widely during World War II in order to maximize war production at the expense of the civilian economy. And so it's not surprising that GNP values bombs and bullets and tanks very highly, while setting at zero the value of our children and the value of the environment. And what's interesting to me is that there was no re-examination of whether the gross national product was a really good scorecard of success as we moved into the future. So we're on this kind of treadmill today where we have GNP measured national accounting systems, and because they're so narrow and they don't include environmental costs and many social costs, they naturally build up a hidden backlog of these social costs. And this increases the costs of pollution control, of dealing with unemployment, dealing with crime, and inner cities that are not functioning. This, in turn, increases the need for local taxes to try to deal with these kind of problems. And in many cases, at the national level, it begins to create deficits or lead to inflation. And then you get a sort of tragic situation where states begin to compete with each other by even deregulating further, and thus increasing these social and environmental costs in order to try to attract industry and create jobs. And finally, as the whole situation gets worse, the economists tell the politicians, well, what you need to do is to call for more economic growth, and then you're back around the treadmill again. And in a sense, we saw the same thing happening in this recent election, as we do in almost every election anywhere in the world. All the politicians are calling for economic growth, and the rather narrow economic view of macroeconomic management tools is that the politicians are told, if you can keep unemployment down, and if you can keep inflation down, and deficits down, and interest rates down, you can get reelected. And what's been happening in more and more countries all over the world is that politicians who make these kind of promises, that they're going to keep all four of these barometers of distress down at the same time, have begun to sound sillier and sillier, because most people intuit that you cannot keep all of those four variables down at the same time. You can push one down and the other three get worse. And of course now we have the problem with trade balances too. And the reason that macroeconomic management on this kind of very narrow model doesn't work anymore is because the real system looks like that. And all of these variables are now interlinked and riding on this global roller coaster of the world economy. And this has changed the game for everybody. I mean, you just have to look at what poor Mr. Greenspan has to deal with. You know, he would like to lower interest rates more to try to push the economy into some growth. But if you do that, there'll be a further flight from the dollar. And if they raise interest rates to keep the currency reasonably stable and keep investors investing in our bonds, then you will deepen the depression or the recession or whatever you want to call it. So all of these interlinked factors, as we saw with the currency crisis in Europe 3 weeks ago, mean that there really isn't any such thing anymore as economic textbooks tell us, and that is a domestic economy. There's no such thing as a domestic economy anymore. And the speed with which the global financial system is operating now has pretty much invalidated economic theory in terms of the two major tools of macroeconomic management, monetary policy and fiscal policy. So I like to just show people this diagram. This is a picture of space junk, which is orbiting around this planet. And there was a study done by the Office of Technology Assessment last year, And to me, this is just a perfect example of the kind of world we're now going into, a totally different kind of world where all our assumptions are going to have to change. And the most important assumption, I think, is that we can have this global national economic competition. In a world like this, we're going to have to do more and more cooperating. And what the OTA report said was that if the spacefaring nations don't get together to prevent more of this space junk from getting out there, most of it is jettisoned rocket boosters and all of this sort of thing, that by the year 2000, most of the useful low orbits where we have our communication satellites will be unusable. So, in a sense, the old model of competing nation states and the kind of economic competition that everybody has been talking about in this last election campaign is going to have to be modified, because we can't go on with nothing but global economic competition. And so what I've been saying for the last 10 years or so is that we are in an era of global interdependence, and the great globalization forces at work, I'm just pointing out 6, you could come up with some others, but we all know them pretty well now. The globalization of industrialism itself and of production, where you don't know whether a car with an American label on it was actually manufactured in Taiwan or Europe or wherever. The second great globalization is, of course, of the financial community, and up to about $1 trillion worth of currencies now slosh around this planet every 24 hours, completely swamping trade statistics. I mean, all this bilateral trade statistics are completely lost in these financial flows, and this is why we can't do monetary policy anymore, because governments don't even know what the monetary aggregate that they're working with is anymore because of these enormous flows in and out. And as we saw in Europe 3 weeks ago, if these global currency speculators really care to make an attack on sterling or the franc or the dollar or whatever, they can bring central banks to their knees in 48 hours. I mean, Britain, I think, spent about $5 billion trying to defend the pound before they finally dropped out of the European exchange rate mechanism, and then sterling fell another 15% after that. The next week there was an attack on the franc, and the French central bank was in equally serious trouble. So there's another implication, I think, that we all realize from this globalization of finance, and that is that money and information now have really become equivalent. And if you've got, I mean, money has become information, blips of information on thousands of computer trader screens. And now, if you have the information, it's as good as having the money, and sometimes you're better off having the information. The money is following the information. The third great globalization, which has changed the game for everybody, is the globalization of work and employment and migration. And we see this every day, where companies go all over the world looking for cheaper labor forces. At the same time, populations are migrating across borders, whether it's people in Eastern Europe trying to get better jobs in West Europe, or Mexicans trying to come to the United States. And we found this was particularly urgent in my home state of Florida. Back in the mid-1980s, we were doing a study on the future of the state of Florida. And we suddenly realized that in a global labor market, if Florida pursued its old economic growth game, which was basically, come on down to Florida, we've got cheap land, cheap labor, low taxes, few environmental regulations, and right-to-work laws. We suddenly realized that if we continued pursuing that kind of strategy, guess who we were going to be competing against in our region of the planet? And we suddenly realized, to our horror, that we would be competing with Haiti, where people are willing to work for 50 cents a day. And so all the legislators began to turn around and realize that that kind of recipe for economic growth, the old GNP measured economic growth, was going to end up putting Florida in the hole. And we began to redefine growth as investing in people, investing in education, investing in our own homegrown economy, investing in our natural resources and our environment, which is our basic export. And of course, all of this, as you know, came into the debate this last election. At last, it was on the agenda. And then the fourth globalization is that of human effects on the biosphere. And I think that space junk photograph is good enough to illustrate that point. The fifth is the globalization of arms sales. And although the Cold War is over and obviously Japan won, we're now in a whole new situation where everybody, the arms companies in the United States and the ones in the old Soviet Union are all out there flogging arms all over the world. And it's a very dangerous situation. And one of the things that is perhaps a ray of hope is that some recent surveys that have been done by a foundation that I'm on the board of asked the American people whether they thought that it would be a good idea to have an international tax on arms trading, with the UN collecting the tax and being given to humanitarian purposes. And 75% of Americans think that's a very good idea. The sixth globalization is that of consumption, and you all know what I mean. You know, people in Africa and Asia watching Dallas, and our Chinese friends aspiring now to the three heavens. Everybody wants a television, a refrigerator, and a TV, and I always forget the third one. But anyway, you know, this whole consumption pattern from the West, which is clearly unsustainable. So we now have this sort of situation where these forces of globalization and all of the interactions that they've created have led to all those restructurings of countries and industries that began to accelerate in the late 1980s. And the first thing that went by the board, as we all know, was the loss of national sovereignty. And so it isn't any wonder, is it, that leaders everywhere in the world sound sillier and sillier, all promising to manage their domestic economies and all of that stuff, where everybody knows that they no longer control the levers that would enable them to do those things. And so at the same time, we have this acceleration and the irreversibility of all of these changes. At the same time, while everybody is still using macroeconomic management models, which assume that things are going to return to equilibrium. So this is part of the paradigm shift that I think is going on now. And it hasn't hit the economic textbooks yet, but I think that you saw some of it happening in the debate this recent election, where they were nibbling around the edges at the management of the economy, although there hasn't yet been a really serious, deep thinking about why macroeconomic management can't work anymore. It's still a very confusing and unfocused debate. But it seems to me basically that you cannot manage highly interactive, dynamic human societies all riding on this roller coaster of world trade using these kind of static models of macroeconomic management, where they're expecting everything to go back to normal, and at some point supply and demand will be in equilibrium. And you know, if you're always expecting the system to come back to equilibrium, you're going to be terribly shocked if you're in this kind of era of global turbulence. But it does mean that when we go beyond macroeconomic models and macroeconomic indicators like GNP, that we don't have to be flying blind. And as probably all of you know, there are a lot of very interesting new change models coming up in the sciences. I'll just remind you of probably the most well-known at the moment, and that is chaos theory. And it always amuses me that some of my most intelligent economist friends are all trying to find chaos theorists to take to lunch and figure out what it is these guys know that they had better learn in a hurry. And so, meanwhile, almost every industrial society in the world is going through a restructuring process. And a lot of the restructuring is accidental, particularly in societies like ours, where the assumption is that God's going to do it and that we don't have to intervene, that the free market can take care of the restructuring. And so what I find, and I'm putting my hat on now as an investor, I'm on the board of the Calvert Social Investment Fund, which some of you may have heard of, which is a mutual fund where we don't invest in companies that are engaged in military production or have bad environmental records or who are unfair to workers or do business in South Africa and all of these kind of social criteria. And the way we look at our portfolio, there is really in the United States very much obvious today, but also in other countries, a sort of obsolescent sector. And these are generally big Fortune 500 companies that were built on all of the assumptions of the past. They were built on waste, built on advertising-fueled consumption, built on non-renewable resources, weaponry, and of course we did have to do that during the Cold War. They're built on non-recyclable products and heavy use of pesticides in farming, extractive industries, fossil fuels, nuclear energy, shopping centers, the whole list here. And at the same time, we found that none of those companies fit our criteria. And so we were looking for companies on the over-the-counter market, the new companies that are coming along now that are built on energy conservation, the kind of companies, service companies that work with utilities to help them conserve electricity. They're companies in recycling and companies in solar and renewable energy, in communications, in organic agriculture, in health promotion rather than high-tech medicine. They're in the restorative industries involved in reforestation. They're in natural foods, and many of these companies have done very well for us. And you find it's a very similar pattern in Europe and Japan. So basically, let's look, this is the way I view an economy. And you know, the economists are always talking about the pie. So I try to look at the total productive society as a three-layer cake with icing. And most economists, their model would represent like the top two layers of this cake. You know, there's the private sector, which is definitely the icing on the cake. That's where the innovation goes on. But the private sector rests on the public sector, as we all know, although some economists give you the impression that the public sector is sort of waste, you know, even though we all know that you cannot have a private sector without the infrastructure that underlies it. And even though we disinvested so heavily in our infrastructure in the past 10 years, we're now going to have to make up for that. There's no way you cannot invest in infrastructure in a complex society. But these two top layers of the cake are really all that goes into the GNP figures. And what economists don't notice is the two lower layers of the cake. And the third layer down I call the love economy, and that's the 50% of all productive work which is conducted without pay. And even in G7 kind of countries like ours and those in West Europe and Japan, at least 50% of all production is unpaid. And there are many studies now that have shown this, whether in Canada or Europe. There was one of the earlier ones was done in France back in the 70s, and it found that 47% of the productive work in France was paid and 53% was unpaid. Now, if you go to societies in the Southern Hemisphere, developing countries, of course, it's much larger, about 80% in most of these countries of all activities unpaid, and the GNP measured cash economy is only about 20% layer on the top. So it really isn't surprising that economic management of societies has gone so awry if they only have a map of half the territory. And what you find now is that in many countries, particularly in Latin America, they have had to start studying what they call the informal economy, the unpaid economy, because if you're in a country, say like Argentina, which recently has had an inflation rate of many 1,000%, and the currency is almost worthless, you'd better start looking at the whole picture of all of the productive work that's going on, whether it's unpaid or paid, in order to see what's happening. And of course, the bottom layer of the productive cake is Mother Nature. And if we forget about nature's contribution to production and we begin to overstress it as we've done now, then it's very, very costly, and suddenly we have to spend $30 billion cleaning up the water supply, or $100 billion cleaning up some of the radioactive waste dumps or what have you. And so, in a sense, what happens if you're trying to manage your society only looking at the economic, at the cash GNP measured part of it, all of the expenditures that have to go on to ameliorate these social and environmental costs that are generated down here and kind of swept under the rug, you have an even greater absurdity, and that is that cleaning up pollution and trying to ameliorate social problems is then added to the GNP. I mean, for example, the oil spill in Alaska sent the Alaskan GNP up tremendously because they added in all of the costs of cleanup, and they were not carrying on the books with any value at all the Prince William Sound and its healthy fisheries and all of the livelihoods that it was providing for people. So this is really how badly we've gone astray with GNP, and it's rather like trying to manage a complex society using GNP as your scorecard is a little bit like trying to fly a Boeing 747 with nothing on the instrument panel except an oil pressure gauge. You don't have any idea if you've got any gas in the gas tank or what your altitude is, and all of these other things that you need to know. So what I've been gathering in the last 4 or 5 years is from around the world all kinds of other statistics of quality of life, which would give a country a better scorecard of overall progress towards social goals as well as merely economic goals. And for example, these statistics were brought out by the United Nations a couple of years ago. And if you added the value of unpaid housework, for example, into the GNP, this is how the numbers would change. And of course here it's dependent on different cultures. Now the Danes, they say that the value of housework, if added to Denmark's GNP, would add another 50%. And other countries value housework differently. Norway 41%. But in any case, it just helps to give you an idea of how inaccurate the GNP is. There's another indicator which was produced by a friend of mine at the World Bank called the ISEW, the Index of Sustainable Economic Welfare. And he redid the numbers, subtracting some of these social and environmental costs from GNP over the years, and shows more of a net GNP. And this is the GNP. We look as if we're doing awfully well here, but of course we're not only sweeping all those social and environmental costs under the rug, but we're actually adding in the cost of cleaning up as if it was more useful production. So that's what GNP looked like, and this is what various calculations of his ISEW look like, where you subtract those social and environmental costs. And you see it's a very different kind of a picture. Now, the United Nations has come out with its own new scorecard of wealth and progress called the HDI, the Human Development Index. And just to show you some of the valuations that they've done, they come up with one sort of aggregated number, and they do rank countries in the same way that GNP does. And the Human Development Index ranking, for example, of the US economy, it goes from number 6 to about number 18 because they are subtracting for various human distress, these kind of social costs I'm beginning to talk about, which GNP doesn't take into account, and are really social costs of trying to maximize the GNP measured view of progress. And they look at drugs and unemployment, pollution, murder, suicide, prisoners, and they have another index too, military versus civilian budget ratio. And so these kind of evaluations and these new scorecards, I think, are going to be adopted quite widely by many countries over the next decade. And it's interesting, if you look at what happened to the United States, particularly over the last 10 years or so, where we were, if you remember in the 1980s, we were all told everything was great. The GNP was going up, the stock market was going up, hooray, hooray. It was morning in America again. And yet, if you looked at some of the overlooked fundamentals, which we didn't have indexes, there were no dials there on the instrument panel to tell us what was happening to these other kind of indexes of progress. And so what happened? We weren't watching our literacy rates, and we began to lag in our investments in education, and our literacy rates in the US dropped to 80%. They're now below Iraq's literacy rate. Iraq's is 82%. Now, of course, we don't admit this. We still tell the United Nations that it's something like 96%, but almost everybody on Capitol Hill will agree it's more like 80%. And then we weren't watching the energy sector. And if you remember, all during the 1980s, we began to lose on the energy efficiency that we'd been making progress on in the late 70s. And so it still takes us 2.5 times as much energy to produce a unit of our GNP as it does our Japanese friends or our Western European friends. So we have become fundamentally uncompetitive in many of these ways. I mean, the health sector, that got a lot of attention in the election, but you know, we all know the figures now, 12% of our GNP, and yet we're not producing any better life expectancy rates or infant mortality rates than the Japanese, who only spend half of what we do on healthcare. And then our waste management, so-called. We were still throwing 90% of our raw materials away into landfills, where they would end up polluting the groundwater, which we then have to spend a tremendous amount of money trying to clean up. I mean, how can we compete with countries that take 50-60% of their materials and recycle it right back into the production process? And of course we can't compete with them. And the kind of environmental costs and resource depletion rates in the US have been fostered very much by our tax code, you know, where we had such things as oil depletion allowances, where we should have oil depletion taxes. And so we were very vulnerable in that way too. And then, of course, we let our infrastructure go to pot. And it's very interesting there again, the problem was that GNP does not carry infrastructure on the books. It's sort of amazing. But, you know, can you imagine trying to run a company like that if you don't have a capital asset account? And so naturally, because we don't carry infrastructure on the national accounts, it looks like maintaining it is throwing money down a rat hole. And it was the same reason that we let our education investments go down, because we don't treat people, investing in people, as a useful thing to do. In the GNP, it's all mixed up with costs. And this is another thing that got clarified in this past election. The Clinton people did put over the point that there was a difference between spending money on investing in infrastructure and spending money on current consumption or giving people a tax cut or something like that. So there was a certain amount of education has been going on about the problems of national accounts. And I think that another thing that happened all during the 80s in many industrial countries is you found that the value systems began to sort of split. And the old short view, which sort of peaked in the 1980s, you know, where everybody was into greed and speculation and borrowing and leveraged buyouts, and naturally we ended up with all this debt financing in every sector and the lifestyles of the rich and famous. That whole value system seems to be peaking out in many industrial countries now, because it simply is not sustainable. I don't know whether you've seen those T-shirts. I've seen some places that I go that say, "Die, yuppie scum." It's a little extreme. But what is happening in many societies is the long view is beginning to come back. The whole idea that we can't be on such a short-term time horizon, and we're going to have to start investing for the long term. And this is even creeping into Wall Street now, and people are trying to figure out how to do venture capital that's more patient and allows entrepreneurs a little bit more time to do what they have to do. And particularly where I have been involved is in this socially responsible investing movement. And when we first started our fund back in 1982, all the people on Wall Street thought we were absolutely crazy, and they said, you know, that if you invest for the long term and you're trying to look at these companies that are part of making a healthier economy over the long run, you're going to lose your shirt. And instead, of course, we found that there really were companies out there that were going to be part of the economy of the future. And there were a lot of investors out there, too, who cared about their grandchildren and didn't want them to inherit a terrible mess and a $4 trillion budget deficit. And so, in a sense, this will give you an example of how this kind of longer-term valuation of investments on Wall Street has been proceeding. And here we are back in 1984 with 40 billion, and 1991, $625 billion was invested with these kind of longer-term evaluations. So we're very happy about that, and there are funds like ours now that have been spawned all over Europe and in Australia and New Zealand and other places. And basically what we've been trying to do is to show the difference between speculating and investing. And, our criteria really is which companies would we like to see in our grandchild's portfolio. And what's really encouraging is to find there's so many investors out there who are willing to invest in that way. I mean, we just had a shareholders meeting, and we asked our shareholders whether they would let us put 1% of the portfolio, we now have about $1 billion under management, whether they would let us put 1% of the portfolio into below market kind of high social impact investments like these micro loan programs for micro enterprises on Indian reservations and in inner cities. And it was just thrilling to find that our stockholders said, yes, great, but we want you to put double, not just 1%, but 2% of the portfolio into that. And so, in a sense, we have really discovered a new market, and this is all part of the value change that seems to be going on. So I've been developing a new kind of GNP, which I call Country Futures Indicators, CFI. And basically, I began with all the ways that the GNP needs to be corrected and reformulated, and some of them now are beginning to be adopted already, going from accounting for GNP in per capita income stated in currency. As you know, that now the currencies are all fluctuating so wildly that most countries now are using something called purchasing power parity, where you go back to looking at time instead of money. In other words, how many hours does a Russian have to work to earn a loaf of bread versus how many hours does a Japanese have to work to earn a bowl of rice, getting back to the real world. And then, very important, correcting the GNP for income distribution, because what happens when you average out incomes per capita, you don't notice if your poverty gap is getting wider. And in many cases, really all over the world, as GNP goes up, poverty gaps have been getting wider. And so you need to watch the poverty gap at the same time you're watching the average income. And then community-based accounting. At the moment, GNP is all constructed on enterprises. And that's part of the problem. If you don't also have community kind of accounting where you can capture all of the costs and benefits, say, within a whole city or a whole state, and you can look at those costs and benefits and trade-offs, those environmental costs and the social costs, and see them all on the balance sheet together, you cannot really get a good idea of whether you're really making progress or you're just making progress in one sector and sweeping costs underneath the rug that are going to come back and haunt you later. And then you have to add in the informal economy, all of the unpaid work, because when it's such a large amount of the total, there's almost no way to look at jobs and employment without counting in self-employed people and the kind of enterprises where people are, and the kind of work that people do for themselves, like growing their own food and making their own repairs and all of those things. And then you need to deduct these social and environmental costs rather than adding them into the GNP, which is a sort of double counting. And you have to account for the depletion of non-renewable resources, and there are many ways of formulas for doing that. You need an energy to GDP ratio or GNP ratio so that you see whether you're doing well on the energy efficiency side as well as just looking at the output. And then a military-civilian budget ratio so that countries can be compared by how well they are dealing with conflicts without resorting to just buying lots and lots of arms, which we're all beginning to realize there's very few problems can actually be solved in the world with Scud missiles or Patriots. I think we're all beginning to realize that. Then, most important, and I'm certainly hoping that the Clinton administration is going to work on this one, having a capital asset account so that we carry all of that infrastructure on the books, and then we'll pay proper attention to maintaining it, and we'll have a sort of net worth statement. And if we had done that, we would have noticed that all through the 1980s, the U.S., based on net worth, was declining compared with all of the other countries of the G7 because we were disinvesting in our infrastructure. Now, a lot of the G7 countries, because of the vagaries of GNP accounting, were doing something which was equally poor accounting practice. And that was, for example, in Britain, where Mrs. Thatcher went in